When I speak with first-time homebuyers, if they have any concerns at all, it almost always has something to do with credit. And I get it, credit is a major pain point. However, it usually does not stop you from purchasing a home. The thing that actually hinders most people is their DTI, aka debt to income ratio. Hi everyone, welcome back to my channel. I'm Shakelia LeBlanc, aka the Loan Slayer, and in today's video, I'm going to explain what is DTI, what lenders use as far as payments to calculate your DTI. I'll show you how to calculate your DTI and what you can afford. And then number 4, I'll also share some tips with you on how to improve your debt to income ratio. So grab a pen and notepad paper and get ready to say hello to your new home. First, let's start off with breaking down exactly what is debt to income ratio. DTI helps lenders assess how much of your monthly income is currently going towards debt. And then it helps them determine how much more you can afford. So they do this by comparing your monthly debt payments versus your monthly gross income. Now, DTI maximum is going to vary from loan program to loan program, as well as lender to lender. And then in addition to that, your personal profile. So I'll start off by giving you the maximum for each program. FHA maximum is going to be 57%. Conventional, 50%. USDA 46%, and then VA loans do not have a max. Now, those are maximum program guidelines. However, from lender to lender, the DTI may vary. So oftentimes I'll see where banks and credit unions have a much lower DTI maximum, somewhere around 43 to 45%. And then in addition to that, your personal profile may cause for lower DTI, meaning if you have a lower credit score, if you don't have a few months of reserves, if your monthly rent payment is drastically increasing, or if you have not been paying rent, the underwriting system may automatically not allow you to go as high if you don't have any compensating factors. Okay, so now that we've defined DTI, let's talk about what lenders include in the calculation. Of course, they're going to include anything that's reported on the credit report. So car payments, credit cards, installment loans, student loans, IRS payments, judgments, all of those things are going to be included in the ratio. I also want to add alimony or child support. Those are debts that, if you're obligated to pay, are going to be included in your debt to income ratio. Now, on the other hand, some things that are not included in the ratio will be utility bills, for example, water, light, Wi-Fi, internet. None of those are included. We also exclude insurance payments for like your car, life, health insurance, as well as daycare expenses. So if you have childcare expenses, those are excluded except for on VA loans. Now, just because the lender does not include these items doesn't mean that you shouldn't consider these when you do your own personal budget to determine how much you can afford as far as your monthly payment. Okay, so let's get to the fun part where I show you how to calculate your DTI ratio as well as how to calculate what you can afford. So let's start with the first calculation, which is the simple DTI ratio, which is monthly debt payment over your monthly gross income. And gross income is your income before taxes are taken out. Once you get that number, you multiply it by 100. So let's use some simple numbers. Let's just say that you have monthly income of $5,000. And as far as debt, you have a car payment for $300, 2 credit card payments, $25 each. And then you have an income driven payment plan for your student loans at $50. So that means your monthly debt is $400. Now, let's also say that your anticipated mortgage payment is $1,800. That means your total monthly debt, including your new mortgage payment, is $2,200. So, what we'll do is we'll take that $2,200, divide it by $5,000, and you should get 0.44. Multiply 0.44 times 100, and your debt to income ratio is 44%. Okay, so let me show you another calculation just in case you want to know what's the most that I can afford. So we'll use the same numbers. And this time we're going to take your monthly gross income of $5,000. And let's just say you want your max DTI at 50%. I don't know if you want it to be 50%, that's a lot. But let's just say you want it to be at 50%. So we will multiply 5,000 times 50%, which is $2,500. And then once you have that $2,500, that's your max DTI, right? You're going to subtract the debt that you have. Your monthly debt, we've already calculated, is $400. That's that car payment, the 2 credit cards, and the student loan income driven payment plan. And what you have left is $2,100. So we basically reversed the other calculation. And now we know that your max monthly payment, if you want your DTI to be 50%, is $2,100. Okay, so now that you know how much you can afford, what do you think? A lot of times when I do this exercise with people, they're shocked. And I always tell people, look, I'm not denying you or telling you you can't move forward, but the math does the math for us, right? I can't change anything when it comes to the numbers. Now, I can share some tips with you on how to improve your DTI, and it's really 2 simple things: decrease your debt or increase your income, right? That's how you make those numbers move, because it's only those 2 things that are considered: your monthly debt and your monthly income. So, one thing I suggest with people is looking at what your balances are on your payment. So, if you have a car payment, if you have only a few $1,000s left, can you save up and get that paid off early? Or can you wait until that car is paid off? Can you pay off a couple credit cards? So if you have 5 different credit cards and they're each 25 each, with very small balances, can we just pay those credit cards off? What can you do to get your debt down? Now, what I will share about paying debt down is your monthly payment is what's most important. For example, if you have a car payment that's $300 a month and you have a balance of $12,000 and you're trying to get a lower DTI, just because you pay the balance down, let's just say you pay the balance down to $7,000, your monthly payment is still $300 a month. We still have to count that against you because it's a monthly payment that you have. So, paying down the balance to zero is going to be the most effective thing. There are some times when we can exclude a payment if it's less than 10 payments left, as long as the monthly payment is not more than 5% of your income. But that's something you definitely want to talk in depth with to your loan officer. Now, again, the other thing that you can do to help your DTI is to increase your income. And that you can do a number of ways. Obviously, finding a higher paying job. I always encourage clients to advocate for themselves, ask for a raise. It seems harder than what it is, but truly advocate for yourself and see if you can get a pay increase. Every bit helps. If you're in a job that does not afford that increase, maybe think about a different skill set. Can you go back to school, get a training or certification to increase your pay that way? But that is a huge way to um, to improve your DTI, as long as you don't increase your income and increase your debt at the same time. Now, as always, I hope this video has been super helpful. If it has, let me know. Leave a thumbs up. And I'm going to ask you a favor. Leave me a comment below. Tell me, what are some topics that you are interested in, concerned about, have questions in regards to home ownership, and I will be sure to make a video about it or answer your questions in the comment section. See you later.